Did you know that a bad investment is worse than a toothache? Just kidding. I completely made that up, but bad investments are still pretty bad. And when you make a bad investment, just like when you have a toothache, it can really make your life miserable. So just like I want you to brush and floss at least twice a day so your life isn't miserable from a toothache, I also want you to think before you invest. Learn from my mistakes and invest smart. So in this video, I want to talk about a few types of assets that I see a lot of people investing in without necessarily doing enough research to fully understand what they're getting into. Obviously, that doesn't mean you'll always lose money if you invest in one of these 9 investments I'm going to cover in this video. But I would still recommend being extremely cautious if you're thinking about investing in any of these assets, because remember, if you put your money in the stock market and just let it ride for the next 20, 30 years, you can probably expect a 7-ish% return year over year on average. And that's kind of the benchmark against which I evaluate investments. So without further ado, here are 9 bad investments. Number 1, collectibles. First bad investment I want to talk about is the whole doggone field of collectibles. Yes, that's a broad category. Basically, a collectible would be anything you're buying for some kind of collector's value. Art is maybe the most obvious example. Maybe that's not something you think of as a collectible, but still, when you buy art as an investment, you're hoping that a collector will eventually buy it from you for more than you paid. Now, when I talk about risky collectibles here, I'm not talking about classic pieces of art, okay? I'm talking about speculative pieces of art that you might buy, at some random gallery where no one's heard of the artist, but, the gallery owner swears that it's going to be worth millions someday. That's what I'm talking about here. But collectibles go beyond the world of art. You could also invest in other collector's items such as baseball cards, rare stamps, comic books, really anything that collectors are interested in. Now, the problem with collectibles is that it's incredibly difficult to predict what future collectors are going to value. For example, the first edition of the Amazing Spider-Man comic book from 1963 could be worth tens or even hundreds of thousands of dollars today. So if you were around in 1963 and you knew all this in advance, you could have bought a bunch of copies, kept them in really secure storage for most of your life, and then walk away with millions of dollars. But for every new comic book series that becomes a collector's item, there are going to be tens or dozens or hundreds of series that never get more valuable than their original sales price. If you've seen any of my videos on investing, you know how hard it is to time the market. Unfortunately, that's especially true for collectibles, since their value is mostly tied to popularity and nostalgia, which is so difficult to predict. Now, I'm not saying that collectibles are bad, period. If you like Spider-Man, and if you have the money to buy Spider-Man collector's items, you should get whatever comic books you want. But I would treat that as entertainment rather than an investment for future value. I know some of you on there are going to say, well, my great aunt had this collector's item and now she's a millionaire. Or, look at this, the Pokemon cards that are worth hundreds of thousands of dollars. Look, I get it. Right? I'm not saying that you always lose money with collectibles. I'm just saying, based on the nature of collectibles, it's doggone hard to predict what is going to be a valuable collectible today, 20 years down the line, 30 years down the line. If you're just getting started investing, I would rather you invest in things that are very likely to be worth much more than they are today, 30 years from now, such as stocks by the U.S. stock market, index funds, and quality rental properties. All right, the number 2 bad investment, penny stocks. Another really common investment I see people make is in penny stocks. If you're not familiar with penny stocks, that term basically refers to any stock that trades for a very low price. The Securities and Exchange Commission defines a penny stock as any stock trading at less than $5 per share, but that's not really a hard and fast rule. Some people might think of penny stocks as less than $1 or something like that. Basically, there's a wide variety of definitions, but basically a penny stock is a cheap stock. Now, the appeal of penny stocks is obvious because you can buy a large number of shares for a relatively low price. So if you invest a few $100s in a penny stock and it suddenly breaks through, then you could be looking at a much higher return than you would be getting from a big company like Apple or Google or Tesla that has a higher stock price. But the downside of this is that it's really hard to verify that a particular penny stock has the potential to blow up like that or even to maintain its current value. There are actually a few really common penny stock scams that you could easily fall into But even if you don't get scammed, penny stocks are still a lot less reliable than shares in larger, more established companies. Of course, that doesn't mean there's no risk involved in investing in a company like Apple, but I think you can at least trust them to have at least competent management and a decent market share for this foreseeable future. On the other hand, if you invest in a penny stock, who knows if that company will even still exist this time next year. So ultimately, I would give you the same advice I gave for collectibles. If you want to buy penny stocks as a gamble, that's fine. Obviously, there's a chance it will work out. But in my opinion, there's just too much risk there. I wouldn't put any significant amount of money whatsoever into something as volatile as penny stocks. Bad investment number 3, little-known cryptocurrencies. Cryptocurrencies, especially little-known ones, are another asset that can be really similar to penny stocks. And again, they're very tempting because we've all heard stories about people who invested in Bitcoin before it really started to grow, right? And depending on how early you invested, you could have purchased Bitcoin for as little as a few cents each. But even if you were a little bit later than that, say 2013-ish, you still could have bought Bitcoin for less than $150. And Bitcoin value peaked near the end of 2017 at just under $20,000. You don't have to be an accountant to know that $20,000 is over 100 times larger than $150. So in just 4 years, you could have grown your investment by over 100 times. That means turning $1,000 into over $100,000, or $10,000 into over $1 million, which is almost unheard of in investing in such a short span of time. And Bitcoin, as of the time I'm recording this, it's above $13,000. So I'm not bashing Bitcoin here. Full disclosure, I do own some Bitcoin and Ethereum, but these are a very small portion of my overall portfolio. I had a foundational portfolio of stocks and real estate first before I even thought about buying cryptocurrency. But what I really want to talk about are these cryptocurrencies that you probably have not heard of. Because these little-known cryptocurrencies, they're the ones that tend to be manipulated through pump and dump schemes. How this works is somebody who has a lot of money purchases a lot of these little-known cryptocurrencies, a lot of coins, and then somehow they convince others that this cryptocurrency, this little-known cryptocurrency, is the next big thing, so other people buy in. That drives up the price. And after the price has been driven up, the person who bought a ton of coins initially sells all of his or her coins, the price plummets, and you're left holding the bag. So you might think you'll have better luck investing in a new and unknown cryptocurrency, but then you're back in the same situation we saw with penny stocks, where most of these currencies are never going to develop any real value at all. I would prefer that you invest in index funds, rental properties, solid investments like that. And if you are interested in cryptocurrency, please don't buy little known coins that could be easily manipulated. Bad investment number 4, real estate syndications. Okay, so if you follow my channel, then you probably know that I talk a lot about real estate. In general, real estate can be an extremely lucrative field, a great investment. On the other hand, there are also some pretty questionable real estate investment opportunities out there. To me, that list starts with real estate syndications. If you haven't heard of real estate syndications, it's essentially involving a group of investors teaming together to invest in a particular property or set of properties. So on a basic level, that could be you and a few friends. Maybe you split a property 4 ways, and then each of you get 25% of the returns. But usually when you talk about real estate syndications, it's not among friends, right? It's about a bunch of investors contributing to a partnership, right? They're funding the deal, and then a syndicator or sponsor looks at properties, tries to get investors interested in the project. Of course, this will depend on the specific syndication you're looking at, but usually the syndicator is just going to be taking a small percentage of the sales price and maybe a management fee or something like that. Now, splitting the cost and the returns isn't necessarily a bad strategy on its own, and it can work out in some cases. But I've seen a lot of real estate syndications fall through for many different reasons. And one of the most common factors is that the sponsor isn't necessarily as knowledgeable or experienced as they should be in order to manage that kind of investment. So if you're investing in real estate syndication, you're putting a lot of trust in that syndicator to find a good property, to manage it well, and to exit properly. Again, that's not to say that it will never turn out well. But if you do invest in a syndication, you want to be in a situation where you're really confident in what that syndicator is doing, because your money's not liquid. It's typically locked up for a few years. So unless the syndicator you're investing with has a solid, independently verifiable track record, stay far, far away. Bad investment number 5, Forex and binary options. Another kind of investment I've heard a lot about recently is Forex trading, and binary options are another opportunity that's almost more like a gamble than an investment. Forex, or foreign currency exchange trading, is when you buy and sell different currencies in order to come out ahead. So if you buy, say, 80 GBP, 80 pounds with $100. Then let's say the exchange rate changes and now every pound is worth $2. That means your 80 pounds are now worth $160 when you go to sell them. And Forex traders are trying to win these kinds of bets by buying currencies at lower values and then selling them when they gain value relative to other currencies. Binary options are a little different from Forex trading. You could buy a binary option on foreign currencies, but you could also buy it for another asset like gold or the S&P 500. What the word binary means there is that you'll either get some cash you return or you're going to get nothing at all. Those are only two possibilities, so it's a binary option. So maybe you think that the S&P 500 is going to go up at a certain date. You can buy a binary option on that. And if you put, say, $100 on that binary option, and you're right, you could get something like $200 if you end up being correct, right? Of course, it might be a little less, a little more, and it's going to depend on how likely people think the different outcomes are. But the point is, you're going to have the opportunity to get a pretty significant return. On the other hand, if you're wrong, you don't just lose whatever the S&P 500 lost, you actually lose everything you put into it. So that's why I said that binary options are in some respects more like gambling than traditional investing. Personally, I think both binary options and Forex trading are just far too risky for the average investor. And even if you are right sometimes, it's going to be tough to be consistently correct about those outcomes, and you'll lose everything you invested every time you're wrong. In the same way, currency exchange ratios are very hard to predict, along with the stock market as a whole. Obviously, there are people who have done this successfully. I'm not saying it isn't possible, but for everyone who wins a binary option, there's probably someone else who loses. There are also a lot of people saying they can help you make money with Forex, binary options, cryptocurrencies, or some other get-rich-quick scheme. I actually get a lot of activity on my videos from spammers and fraudsters. These are just a few of the comments I received recently. You can see them on the screen here. If you see these kinds of comments on my videos or other videos, please just ignore them or report as spam. And it's pretty obvious these are spam, right? Sometimes there's these manufactured comment exchanges between multiple YouTube commenters in the spam, and these two commenters are probably the same person. For example, here we have a fake interaction between Anthony Grayson and Isabella Williams talking up some guru or something, and this is obviously a very fake interaction. In general, and this sounds obvious, but when something like this sounds too good to be true, it usually is. So ultimately, I would rather put my money in the S&P 500 itself and go for those long-term gains rather than betting on whether it's going to go up or down at a particular time. Bad investment number 6, annuities. Okay, I'm not sure I would technically call annuities an investment, but annuities are another really popular option. In fact, total annuity sales in the United States were estimated to be over $200 billion in 2018. Some of you may not be familiar with annuities, and basically how they work is that you'll give the annuity company either a lump sum or some kind of regular payment, and they'll pay you the money back over time. So let's say you pay into an annuity plan until you retire, right? Then you'll start receiving regular payments when you're no longer working and you need to supplement Social Security and whatever other sources of income you're relying on during retirement. A lot of the specifics are going to depend on the specific annuity. For example, some annuities offer a fixed interest rate. Others are going to let you invest in mutual funds, which means your returns are going to depend on market conditions. Now, there's an obvious appeal to annuities, especially if you have some extra cash now and you're concerned about retirement. Then it's logical that you would want to pay into annuity while you're working and get those benefits when you stop getting income from your job. Unfortunately, annuities also come with a few problems, and I think it makes a lot more sense for most people to invest their own money rather than paying into an annuity. What do I mean? Well, the first drawback to an annuity is that most of them charge a lot of fees, and these are going to make a pretty big dent in the value of your investment. Another issue is that you'll only have access to the money on the annuity company's schedule. So if something comes up and the regular annuity payment isn't enough, then you're going to have to pay substantial penalties in order to access the rest of your money. And I think it's important to recognize that annuities are an insurance product rather than an investment. So the company who's issuing the annuity is going to win more often than they lose. On the other hand, one of the advertised benefits of annuities is that they'll cover you in case you outlive your retirement savings, but you're actually more likely to outlive your retirement savings if you invest in an annuity, particularly if it has a fixed interest rate and you miss out on the gains you could have earned if you had invested in stocks. Bad investment number 7, whole life insurance. One question I hear a lot is whether life insurance is a good investment. And the answer is, well, it's kind of complicated. There are basically two kinds of life insurance. So on the one hand, you have term life insurance, and on the other hand, you have whole life insurance. Basically, the difference is that term life insurance only covers you for the length of the term you agree on when you purchase the coverage, while whole life insurance covers, well, your whole life. So a term life insurance, if you want life insurance for a term of 20 years, right, the insurance company will look at your profile and your risk factors and tell you how much it will cost to get a certain amount of coverage. You'll pay your premium every month. If you die before this 20-year ends, your beneficiaries get the payout. But if you die after those 20 years, well, your term is up, right? It's over, right? Even if it's just a day after the insurance expires, you're going to be out of luck, even though you put all that money into the coverage. So term life insurance is essentially a bet against your own life. And this can be a smart purchase, especially if you're young and healthy. Because if you're young and healthy, you can get more favorable rates. Also, if you're young, you might not have enough of a net worth yet where you could provide for your loved ones and those who depend on you if you pass away. But by the time the term expires, say 20 years later, hopefully you've had a chance to put more money away and you don't necessarily need to rely on a life insurance payout. So that's what term life insurance is. Whole life insurance is basically an entirely different type of investment, okay? And personally, I think for most people, it's not a great investment. The difference between term and whole life insurance policies is that with whole life insurance, you'll always receive a payout when you die, right? There's no expiration date on those benefits. But with term, like I said, after that term ends, you aren't insured anymore. Of course, the specific terms are going to vary from policy to policy, but in general, with whole life insurance, you're going to be making payments like you would with term life insurance. And over time, those payments are going to increase the cash value of your whole life insurance plan. So it's different from term life insurance, right? And other types of insurance where you pay a premium in exchange for coverage. And that's it. Very simple equation, right? With whole life insurance, instead, you're putting your own money away for the future like you would with a retirement account or something like that as the cash value of the policy increases. Now, again, every policy works differently, but the main reason I recommend against whole life insurance for most people is that it just isn't an efficient use of your money. One of the advertised benefits of whole life insurance is that you can borrow against the cash value of your plan later on. So if you lose your income at 50 or something like that, then you'll be able to pull some cash from your life insurance plan. But the cash in your life insurance plan is actually your own money that you actually contributed, and you would have possibly even more convenient access to it if you had just invested that money. On top of that, whole life insurance premiums are typically far, far, far more expensive than term life insurance premiums. And for all the benefits that are often talked up with whole life insurance, tax and otherwise, the sky-high premiums typically kill any attractiveness it may have had for the average person. So if you're considering whole life insurance, in most cases, rethink it, okay? Because I think it might make more sense for you to pay a lot less money for term insurance and then put the difference between the term premium and the whole premium into a retirement account or even a regular brokerage account. That way, you'll be covered by your term life insurance policy if something happens and you die in the next 10 or 20 years, but you'll also be putting money away for the long term, and it won't be locked away in a whole life insurance plan where you're going to be losing a lot of value to premiums. Personally, I think a lot of people who invest in whole life insurance don't really understand the other ways they could save for the future. And in general, keep in mind, it's oftentimes just more cost effective to invest money yourself and get term insurance if you're really concerned about being able to provide for your family after an untimely death. Number 8, bonds. The next asset I want to cover is bonds. Now, I explained why I personally don't invest in bonds in another video, and I'll put a link to that one in the description for anyone who wants to know more specifically about bonds. So I don't want to spend too much time on bonds here, but the main reason I avoid bonds at my age, in my 30s, is that they tend to gain value pretty slowly, especially compared to other asset classes like stocks and real estates. Yes, that growth in bonds is relatively consistent compared to other asset classes. You're less likely to lose a lot of money quickly during a crash or something like that, but at the same time, you're not going to get the same returns in the long run that you could get with stocks or real estate, for example. So in a sense, bonds are safe. I don't think there's anything wrong with putting a small percentage of your portfolio in bonds, especially as you get closer to retirement. But in general, I would only do that if I think I might need to withdraw within the next, say, 5 years. Remember, the longer you're planning to hold your assets, the more I would lean toward putting money in stocks rather than bonds, so you can maximize your gains over the entire length of that investment. Okay. Again, I'm speaking as someone in my 30s. I have many, many decades until I retire. Okay. If I was somebody, say, 20 years older than I am, I would probably have part of my portfolio in bonds. Number 9, cash. Okay, I've already covered 8 of my least favorite investments. The last one I want to talk about is cash. Now you're probably thinking, okay, Logan, I mean, come on, cash isn't really an investment. And that's exactly my point. Every investment has its own pros and cons, but keeping your money in cash completely prevents you from generating any returns whatsoever. I just talked about how bonds aren't likely to gain value very quickly, especially compared to stocks, and that's true. But even a mediocre year for your bond fund is still usually going to have at least some growth. On top of that, it's not just that cash doesn't gain value, it's also that cash tends to lose some value every year. Just look at the price of things from 20, 30, 50, 60 years ago compared to what it is today. Inflation has fluctuated between 0 and 3% over the past 10 years. So it's not like you're going to lose a lot of money overnight, but even just a couple of percentage points will add up to large-scale losses over months and years of inflation if you just keep your money in cash. So this is a crazy example, but let's say that somehow you came into $10,000 in 1950. What could you have bought for $10,000 in 1950? You could have bought a pretty stinking nice house that would probably be worth hundreds of thousands of dollars, if not millions of dollars today. Okay. Another thing you could have done with $10,000 in 1950 is invested in the stock market. If you had invested $10,000 in 1950 in the S&P 500, do you know how much money you'd have today? Do you know what that would be worth? It would be worth over $18 million. On the other hand, let's say if you just kept that $10,000 in cash in 1950, what would it be worth today? It'd be worth $10,000. It's a hefty, it's a nice sum of money, but it's not $18 million. This is why you need to invest, folks. I do believe in emergency funds. I think you need some cash there. But beyond that, after you've knocked out your high interest debt, I want you investing. Link at the top of my screen for my video on investing for beginners. All right, everybody, that's all I have for you in this video. Obviously, there are a lot more than 9 bad investments out there, but these are a few of the most common ones that I've personally seen people invest in. And again, I want to emphasize that none of these investment ideas are always bad ideas. For example, if you follow cryptocurrencies and you study them really closely, you might be able to make an informed investing decision. Or you might be really confident in a real estate syndication where you trust the syndicator. He or she has a proven track record, right? And you have reasons to believe that they can get you the returns you're looking for that would exceed those you could get in the stock market. So the point of this isn't to say that these are always going to end badly. It's just that you should be really careful to understand the pros and cons of each investment, because I have seen a lot of bad investments in all of the asset classes I discussed today. I'm sure I missed some other risky investments. Some of you have probably seen people lose money in other opportunities. So make sure to leave your thoughts in the comments for myself and for everyone else who is watching. As always, thank you so much for watching this video. I really do appreciate it. Don't forget to give me a big old thumbs up below for the YouTube algorithm, and I'll see you next time. Bye-bye.